I'm Brooke Masters. I'm the Financial Times' chief regulation correspondent, so I spend most of my life looking at all of these regulations and whose ox is getting gored where. I have the distinct pleasure of leading a panel entirely composed of current and former members of Ernst & Young, except me, of course. And we will be discussing the impact of all of this regulatory ferment on the supply of funding to the real economy. We'll start with brief introductions of the panelists and start some chit-chat up here, and then hopefully throw open to you guys because you're the ones living with the consequences. Starting on my left, we have Patrick Trew, who is a partner and chief risk officer at CQS Hedge Fund. He is having to live with applying all this to a hedge fund, which makes him sort of interesting in that we usually hear about most of the regulatory reform as it applies to banks and insurers. So he'll have a good perspective on that. Next to me is Alan Trotter, who is finance director at Alliance Trust, and he was previously at Legal & General, where he was corporate development director and responsible for the central finance function. Both Patrick and Alan started off at E&Y right after university and fled. Chris Price, however, was not so wise, and he now leads Ernst & Young's financial services business in the UK. He, however, unlike the other two, trained as a lawyer and started off at Freshfields. No area is more contentious when it comes to regulation about how any new regulation will affect the real economy. Right now, there are competing studies that say all kinds of things, but just to give you an example, in the Basel III capital reforms for the big banks, the Institute of International Finance, which is the big global banking lobby, suggests that if we enact all of these reforms, including charges for the SIFIs, which are the very large banks, it will add 350 basis points to basic lending and cut 3% off the world GDP. By contrast, the Bank of International Settlement, which is home to the Basel Committee, has done its own impact study, who suggested it will add only 35 basis points to lending, and in fact lead to higher GDP over the long haul because there won't be so many cycles. To split the difference, Standard & Poor's has come up with its own impact assessment, and its suggestion is that the impact is about 150 basis points, and it's concentrated for businesses with lower credit ratings. So that if you are a AAA rated company, probably won't have much impact at all, and the BIS might be right. And if you're a junk bond issuer, you're looking at what the IIF is threatening. Similar conflicts have also arisen over EMIR, parts of Dodd-Frank, and of course the AIFMD was threatened to destroy all hedge funds, private equity, and real estate if it wasn't changed. And maybe it has, and maybe it hasn't. Where the truth lies in all this is very hard to determine. I've spent hours looking at it, and I can't decide. But if we get it wrong, it could be fatal to the financial services industry and to our larger economy. So on that ominous note, I'm going to turn it over to our panelists and ask, so what do you think will be the impact of the current regulatory change on the availability of funding? Why don't we start with Patrick?
Well, I think certainly, well, I can't give you a precise number, and it would appear that no one else can either. I think it's quite clear that bank the funding costs of bank debt are going to rise. We're also going to see it become somewhat more scarce with impending legislation effectively curtailing the amount of balance sheet that banks can extend to their corporate clients. I think one needs to look at two separate parts of the equation, particularly in Europe. One needs to consider large financial institutions, large corporates that potentially have access to the high-yield debt market, but that have historically relied on their banking relationships to source finance. And then separately, one needs to consider smaller organizations, the SMEs, that may not be able to tap either the bond market due to their size, but may no longer be able to access lending from the large financial institutions. And that's going to cause a range of institutions to start looking to different sources, those large enough to look to the bond markets. We think there will be increasing disintermediation of banks in that regard in Europe, as happened many years ago in the States, which has a much more mature high-yield bond market than has developed in Europe. But within the SMEs, we need to find additional solutions, additional lenders, effectively shadow lenders, who need to attempt to fill that gap. We also need to consider the impending challenge of changing regulation and its impact on the CLO market, the collateralized loan market being another source of bank-style lending that will reduce significantly over the next 4 to 5 years.
Alan, you want to put your 2 cents in?
Yeah, thank you. Interestingly, when I was speaking to one of the representatives from one of the UK banks recently, they said that they had at least 81 different major regulatory interventions on the go at the moment. And that, ranging from capital to liquidity to the Robin Hood tax, to the FATCA Dodd-Frank, as you've mentioned, Brooke, and indeed the bail-in bonds as well. I think of those by far, or certainly the greatest, is the capital requirements. I think it's not yet clear how they're all going to land. We've got Basel III, we've got CRD4, its implementation in Europe, and we have the Vickers report, ICB report, and we've yet to kind of fully land on which of all of those three, and no doubt others, which will land. But suffice to say, banking is different, the cost of funding is different, the relationship with customers is different, and the returns that banks are going to make are going to be less going forward.
Chris?
Our estimates would be pretty similar to Standard & Poor's. We sort of come in around 100, 150 basis points in terms of increased cost. And I think I agree with the rest of the panel that at that point you start to risk a have and have not culture in the corporate funding world, or those able to access capital markets directly and having other forms of finance immediately available to them compared to the SME market, which is always going to need to traditionally look to its banking relationships to drive the majority of its funding, for whom that cost could fall on that segment of the market disproportionately. And in terms of the driving of that cost, I agree. I think there are two things. One is the blizzard of regulation that people are dealing with at the same time, and in some cases, the timing at which that regulation has come out runs the risk of making it now looking either disjointed or at least overlapping to an unnecessary extent. And I think maybe the liquidity provisions of Basel III would be the one area that people would maybe single out in that regard.
In terms of that, the liquidity provisions in theory don't go into effect for real until 2015. And the Basel Committee has said it's going to rewrite some of the details in the next year or two. What part of it to you seems distorted? Is it the sovereign bonds issue, or?
No, I think it's the policy issue. I think that a common theme is that individually each part of the regulation makes an awful lot of sense. But when you put every aspect together, you now have a policy environment that has matured over the past 2 to 3 years. And I think the liquidity aspects in their current form, and it's good that they will be being revised, maybe are less important. There are aspects of them that are less important from a policy perspective. So if one has an environment where you have a very high capital requirement for a retail business, a ring-fenced business to step in the event of failure, and other institutional mechanisms to provide short-term support, liquidity and the disproportionate cost of some of those liquidity provisions looks maybe something that should be revisited.
Certainly, you hear that from the banks. It's probably the single most upsetting point of the Basel III package that you hear from the banks that they really, really want changed. In the U.S. right now, we're starting to see the emergence of private equity funds that are lending directly to medium-sized enterprises as a way of finding, they are reaching out to companies with a turnover in the $500 million range, which is not small at all. But those companies have started to fall through the cracks in the U.S. as the big banks scale back. And so that's sort of the beginning of the emergence of shadow banking, as Patrick was talking about. Do you see other signs that there really are people stepping into the breach, or are we doomed to face a couple of years where nobody's lending anything to anybody?
I think certainly in terms of the business development corporations that you mentioned, they have certainly started to establish themselves in the States with a number that have gone through the $3-4 billion lent in terms of size. And we have seen signs of those moving over to Europe, where there clearly is significant opportunity there. Earlier this year, Neuberger Berman launched a fund that focuses on that. Babson are attempting to place capital at the moment in that sort of regard. So I think unquestionably we will see a migration to effectively equity forms of capital being raised in order to lend debt finance, and in particular the economics there make sense in the SME zone. In addition to listed vehicles, another source of finance to that segment that we think will develop is increasingly a form of securitization. There are challenges, obviously, post-2008 with regard to using securitization to fund SMEs, but while the economics don't work so well for CLOs focusing on large loans to large corporates, it may make more sense within the SME area where one can charge somewhat more and where the economics may make more sense.
Thanks for that. I'm going to ask one more question, then you guys get your thinking caps on, and it'll be your turn. Alan, as an investor, fundamentally, does any of this sound at all attractive? Do you want to give your money to these people?
Do you want to give our money to banks?
To banks or to shadow banks?
Certainly, I think we need to be careful of shadow banking. Absolutely. I think for us or for any economy, and certainly as an investor, we want the banking system to be fully functioning, and for investors to earn a return. I think as an investor, for us, it's as much about the lack of volatility in earnings, and we want a recurring dividend stream that's predictable, and we want risk-adjusted returns. So we want to know that the returns that we are getting are commensurate with the levels of risk. There are certainly we're certainly light on banks currently, but I think for the future and for all economies, we need fully functioning and efficient banks.
Chris, you look like you want to jump in.
No, I was going to add that I think that there's been some surprising emissions from the kind of funding environment as well, that with corporates with so much cash on their balance sheets, a lack of development in things like vendor financing has been quite surprising. And I would hope that over the coming 2-3 years we see that develop and be facilitated somewhat more by some of the participants in this room, because I think that should play a significant role as well.
Interestingly, in China, surprisingly, a number of corporates have gotten into direct lending either to their suppliers or just to other people in the economy. And immediately they have a central finance function that directs companies to do things, which is probably makes it less scary to actually enter this. But it does seem to be starting to have an impact there. Shall we throw it open? Is there questions for the panel? There's one here and one up there. So if you guys can, whoever gets the mic first gets to go first. There goes my mic.
Thank you. Tony Gillen from the Institute of Ideas. I'd like to ask the three of you to address the broader backdrop to this situation. Chris, you just mentioned corporate cash on balance sheets, and obviously the blizzard of regulation. All of this takes place against a context of what might be regarded as quite a risk-averse society, a society that's not sure about the benefits of economic growth. We hear a lot about these sorts of things. These things must, the political context, the cultural context, the lack of trust, the suspicion, these things must have an impact on what regulations are put in place. I certainly remember a very heated debate about genetically modified crops and biotechnology in the late 90s. The response to that was more regulation, and the regulation wasn't based on what was going to be good, it was based on what is most likely to placate the campaigners and who is perceived to be the public. Rather than confront that and get involved in the debate, the industry and the scientists were afraid of being part of the debate and wanted to sort of keep out of it. And there was this idea that regulation could do the work. Looking at your situation, which in many ways seems quite parallel, a very heated, difficult situation, I don't blame people for not wanting to get up there in front of the media or in front of campaigners or whatever. And I think Bob Diamond should be congratulated for being prepared to be part of the public debate. I don't blame you for not wanting to get involved, but meanwhile, this situation is rolling on. More regulation will come, some ideas will come that will be good, but a lot will come that will be bad. and there's not enough engagement from the financial sector in the debate publicly. Yeah, having a debate here, largely with yourselves, which is great, so you can understand what you think. But in terms of the wider public and what anybody else thinks, the engagement isn't there. So that's a sort of statement, if you like. And I'm asking you, do you think you could do a better job as an industry of putting forward a better argument about your role, and therefore perhaps not accepting all of these regulations?
Somebody want to jump in?
From our perspective, within the alternative industry, I mean, the principal legislation and regulation that's coming through is the Alternative Investment Managers Directive, which certainly does improve certain aspects of the industry with regard to providing protection and creating a level playing field. Historically, hedge funds in particular have operated very much absent many of the sort of rules around prudential capitalisation, and that's certainly changing over the next few years with the implementation of that directive. But ultimately, that is something where there has been significant engagement with regulators and media. I'm not sure that's really, it's fair to say that's happened behind the scenes. I think people are, the industry is happy to engage, and indeed does engage, and that's equally true in the States as well.
I think it's. I think the debate has become so fundamental and so challenging to some core principles and behaviours in each of the societies that the past 3 years have touched, that we are so far away from having that debate on fundamentals. So, is it really sustainable for us to have as a desire and as a challenge for some of our lead institutions a strong growth, low inflation, low personal debt environment in the UK? Well, that would be a pretty good trick, I would suggest. And I'd like to understand a long-term plan as to how to do that. So I think some of the fundamentals are so challenged that is it disappointing that the financial services industry, as an industry, hasn't voiced its opinions in that fundamentals debate enough? Yes, I think that is. But I prefer it to be the debate to be focused on that rather than particularly our response to regulation or aspects like that.
I would say also, just as the journalist has to write about this sort of stuff, that the industry's responses have tended to be, we're dealing with that, go away. It's not covered itself in glory in wanting to engage on fundamental questions. For example, whether or not you like it, banker pay is an issue that exercises the public. And the industry's response universally is, we've already fixed that. Stop bothering us. And then studies came out a couple of weeks ago that show that the use of guaranteed bonuses is higher than it was before the financial crisis. That is not reassuring to the public. They are not going to trust you on liquidity and capital if they can't trust you on pay. But I haven't let Alan have a turn.
I think you did right that lack of trust leads absolutely to more regulation. I think though I would hope that we are seeing the starts of signs of recognition of that. I think it will take time. I think it is a culture and ethics thing. I think it's that we don't, as an industry, want a massive rule book. But in order to get that to be the safeguardians of that rule book, if you like, it has to be, in dealing with it in practice, people need to respect it and not look continually for ways to get around it.
I just very, very quickly just ask you to consider one thing, because when you talk about this rule book, you're looking very much at the detailed picture, which is your job. If you step back and look at the bigger picture, people. Sentiment and narrative are so important. They're hugely important to politicians. The narrative at the moment, Occupy London claims to speak for 99% of the population, doesn't have a programme that it's putting forward, isn't making specific criticisms, is saying we don't like it, and claims to speak for 99% of the population. The city's voice in that debate is not really there. And how is it the case in our society that a small group of people who claim to speak for 99% are themselves not being held to account for their views? So I think there's a danger of looking at too much of the detail, which is important to you individually, and not stepping back and looking at the bigger picture, which shapes the detail that you have to deal with. Sorry.
I think you're now getting into advocacy. But I would point out that, Occupy Wall Street seems to have gotten the attention of the Archbishop of Canterbury, who is now in favor of a financial transaction tax. So I would be careful at writing them off as a small group that nobody is holding accountable. Shall we let someone else talk?
John Cook from the TheCityUK. This isn't going to be advocacy, I think, but it is a question on the impact on sources of funding, with particular reference to trade finance. I wondered what the panel thought about that. We all know that rules on capital attempt to be calibrated to risk, and yet risk is extremely difficult to analyse. Recently, the Basel Committee adapted a bit its rules on trade finance, but in ways that are commonly thought to be inadequate. I wondered whether the panel thought that this was an area in which other sources of finance might step in, whether there was evidence of some kind of shadow banking starting to emerge on trade finance. It's really a case in point on the wider questions that were discussed in response to the earlier question.
Does anybody have a view on trade finance?
I don't have a direct view on trade. I mean, I think what we would say is that, there are another sector which is definitely wanting to participate in lending in the current absence of the banks is the insurance sector. They're particularly keen on infrastructure assets, on long-dated corporate bonds. They just hope that Solvency II, when it lands, will make it more pragmatic for them to do so than it's currently drafted.
It will be interesting. Trade finance is one of those really tough things, which is that it's not that high risk, but it's getting caught by the belt and braces approach at Basel. For those of you who don't do the geeky details, trade finance is low risk weighted, and on straight capital, when it's risk adjusted, you don't have to hold a lot of capital against it. But there is now something called the leverage ratio, which says pure size, you have to hold something. And that's there largely to prevent banks from cheating on their higher risk assets, but it has caught trade finance. And the question is, how do you help trade finance, which everybody agrees is low risk and good for the world, without opening a big loophole that banks like the next Lehman Brothers or MF Global will be driving their big trucks through? And there is not a good answer yet. Should we try some more questions? There's one dead ahead of me. And is there someone else that we can get lined up?
There's two, actually. Firstly, it's a point of information. For about 200 of the last 230 years, this problem was solved perfectly well with trade finance. Problem was solved perfectly well through the liquidity allowance for it at the central banks, which was fundamental to the provision of trade finance. So, and it's something perhaps we ought to be looking at again for a very obvious reason. That actually, if you listen to Montague Norman or read Montague Norman's arguments on the case, he was very against the whole idea of government bills as a form of liquidity because they weren't self-financing, they weren't self-liquidating. Whereas trade finance is. And there is no history of central bank losing any significant sum of money at all through that process, including in the First World War, when they netted off all the UK-German, or the Axis and UK transactions, they actually came out virtually nil. So there was, and what was left was recovered after the First World War. So just as a point of information, there is a solution to this, and it's one we really ought to be looking at. The other thing I wanted to point out was that. And I wonder if each of you could sort of give your view on this. One of the things that's worried me about this whole debate is that I've listened to people say two totally conflicting things all the way through it. And it's been person after person after person. One of which is, we think the industry will be a utility with return on capital at or below the cost of capital. Not certain how you do it below, but at or below the cost of capital. That argues for something that's going to be big, consolidated, etc. And we want a highly competitive industry with bidding in lots and lots of new capital. Now, those two things cannot possibly be two models of the industry you're designing regulation to create. You've got to go for one or the other, but you can't design both because that's just a nonsense. And what worries me is it's been a nonsense that people have consistently said to themselves. They come out with one statement which goes on one side and one statement which goes on the other. Now, what sort of industry are we actually designing regulation for, in your views?
You want to take a shot, Chris?
I agree with you. When you look at those institutions currently challenged by the competition authorities to be disposing of aspects of their business following the receipt of state aid last time around, they will all say that's a nigh on impossible process to conduct at the moment, because it's not the world's most attractive industry for new participants of a shape and size and ability that the governments or competition authorities would like to see participating in the industry. So that clearly bears out your point, that the attraction of sufficient capital to drive a competitive environment into aspects of the industry at the moment is a very challenging situation, i.e. can't really be done. Which of those lines it should be going down? Should it be promoting competition or should it be promoting stability? I think at the moment you'd have to say it should be promoting stability. And competition will evolve as people understand how to make better business models with the regulation they face. And inevitably, and I think our industry shows the innovative quality over the past hundreds of years, it will find a way to do that. Whether that means the death of universal banking, whether it means more striated and segmented financial services industry, who knows? But for now, I think the focus should be on stability.
Either of you have a view?
Yeah, I would say I would echo Bruce's comments. I think we're trying to build a stable banking system that for which this will not reoccur, or certainly that is the aim. I think that stability does come paramount, first and foremost for now. I think the banks will look to design products that are capital light. That as yet, how that will then come through, Brooke, I don't think is yet fully formulated by the banks. But for sure, they need to be products that are right for customers, consumers, first and foremost.
Do you have a view, Patrick?
Absolutely. I mean, as everyone else has said, stability clearly the key. I think that competitive distinction will come through increased disintermediation. So I think you'll get banks focusing on a somewhat smaller and ultimately the larger part of the industry, while you find other solutions, whether it be, as I mentioned earlier, use of the corporate debt market to a much greater extent within Europe in order to perform effective financing at some competitive levels, which the banks may no longer be able to sort of lend on.
We have time for one more question if somebody has something short. Or we could just move on, which would be, I think, make the organizers really happy. Thank you guys very much. I think this is probably the most important topic we could do. And thanks for all of your help.